Good morning, everyone. I am Prachi Jain, Company Secretary and Compliance Officer of Apollo Finvest India Limited, welcoming you all to the investors call. Apollo conducts these investor calls every quarter to facilitate an interaction with our current and prospective investors. We have Mr. Nikhil Inani, the Managing Director and CEO, and Ms. Diksha Nandia, Whole-time Director and CFO of Apollo, to brief you about the last year's performance and the previous year data. In case during the meeting you have any questions or insight for us, please drop your questions and insights in the Q&A section. I will hand it over to Nikhil now to take this ahead.
All right. Thank you so much, Prachi, for getting me on stage. As usual, I think I'm very, very happy to obviously host our earnings call. And, this time we decided to do it a bit different. We have a presentation prepared, and I would like to kind of, take you through that because I think the last year has been very, very interesting for us. Just give me a minute. I'm going to be starting to share my screen, and then we can begin the conversation. All right. Is my screen visible?
Yes.
Perfect.
Yeah.
All right. So, the last year has been super interesting, right? And largely because, it was in many ways, I would call this a year of two halves. And why would I say this was a year of two halves? Largely because, as the digital lending guidelines came in, from RBI in around, December of last year, we did take some time, as did the entire industry, to kind of absorb all of the big changes that, that brought about, right? And there was no bigger change to the Apollo business model than obviously the cap on FLDG, which was, made to be 5%, right? And obviously the minute that 5% cap happened, I think, we had to in many ways reevaluate the kind of people in terms of, LSPs that, or loan service providers that we were essentially, working with, right? Because a lot of our commercials, prior to the digital lending guidelines was structured in such a way that essentially it provided us with a lot of commercial comfort while, lending to a certain audience, which, which may have been traditionally looked at, as slightly more risky, right? And the result of this was like a reevaluation of, which are the kind of, partners we want to continue business with and which are the kind of partners we want to discontinue business with, right? And during this evaluation, obviously there were certain loans, on our book. And even though, commercially it had no impact on our profit, essentially, right? We basically had to, we had to basically showcase, these bad loans, on our book this year, and discontinue those partners, right? Because, the kind of performance that they had in terms of loan portfolio, it wasn't really, keeping in line with obviously the 5% cap which RBI came about putting. And this also, made us really evaluate, how do we kind of think of our business moving forward, right? And the clear, silver lining in the DLG guidelines which came out from RBI was that, finally after, we've been doing this for almost now 7.5 years at this point in time, after so much time, RBI had come in and obviously validated the entire industry by providing clear guidelines. But most importantly, because there were clear guidelines, from an Apollo perspective, we decided that now it is a great opportunity for us to actually go in, evaluate all the different partners which are there in the ecosystem and really, really think about now finally flexing our muscles and, scaling big time. And in order to talk about, how we actually went about doing that, I'm going to hand over the stage to, Diksha, and she's going to take you through that. Diksha, you want to come in?
Yes. Hello, everyone. Hi. So, moving on slides, Nikhil. Yes. So let me take you through what happened post DLG, what our thought process was. Of course, we realized that, in our quest of searching for digital lending partners, we realized that NBFC stood out. Of course, our criteria for searching partners was one, partners who can scale, and partners, most importantly, who have great quality books, owing to the cap that FLDG cap that we have from RBI. That became extremely important. Now, in this quest of finding good digital lending partners, we realized that NBFC stood out. And the reason NBFC stood out is because obviously they're regulated, so they're more compliant. There's a lot more confidence they instill in lenders, and they scale a lot better. Their quality of books is amazing. And all of that made us decide that, okay, we need to strategize and we need to move our strategy more towards the regulated space, the NBFC space. Not that LSPs don't have good quality books. We have a handful of them who are amazing as well. But honestly, the VC funding also moving more towards the regulated space sort of double-clicked and validated our thought process that NBFCs were the right way forward. Just to name a few partners who we have on board, and we've had on the last financial year, from an NBFC standpoint, we have Branch, Cashy, Sogamya, True Credits. From an LSP standpoint, and when we say LSP, we mean non-regulated partners standpoint, we have some amazing partners like OK Credit and JAR, and all of these partners are sort of contributing to our entire company's revenue at the moment. Moving on to the next slide. So how is it that we started partnerships with these companies? Of course, our non-regulated partners, our partnership remains the same in an LSP fashion, where 100% of the loan is on our books, and that's how we move forward. But to expedite our partnership with regulated entities, which is your digital NBFCs, what we decided is we started by giving them short-term term loans. Because any sort of co-lending partnership, and that's primarily the route that we've been taking with regulated entities, takes time. The integration setup time is a little longer there. We need to both be aligned in terms of how the loans will be shown on our LMS, the accounting practices, even the escrow mechanism, all of that takes time to set up. And obviously, to make sure that all of this integration time lands up yielding us some benefit, we landed up giving them a term loan, a short-term term loan, just to get the relationship started, and so that it yields us some revenue as well in the meantime. And eventually the co-lending arrangement kicks off with them. Now, what's different when it comes to a co-lending arrangement? Contrary to an LSP partner where 100% of the loan is in our books, in a co-lending arrangement, it's in a certain proportion. Now, this lands up having a dip on our revenue. It's because earlier 100% of the interest on all the revenue of the loan was coming in our books, but right now only that share which is supposed to come in our books is sort of reflected in our books, and therefore there's a hit in terms of our revenue. However, our business model from a PAT perspective, PBT perspective remains the same, so it doesn't impact us there. So that's something worth noting. Coming on to the next slide. What that meant from an evolution standpoint when it came to capital commitment. Now, as we all know that Apollo has always worked in a capital commitment model standpoint with all our fintech partners. What that means is, in order to make sure that our partners are highly motivated, they are committed, and they truly believe in scaling with us, we have capital commitment models with them wherein we ensure that they utilize our capital, which has already been pre-decided in a particular year. And if you see, there's been a shift in this commitment. If I compare to FY23 and FY24, FY23 primarily had our entire capital commitment coming in from non-regulated LSP partners, and now most of it is coming from digital lending partners. So that's been a big switch for us. So this is what our new business model in a way entails post DLG guidelines. To take you through the impact of this and what it means for Apollo, I think I'll just hand it over to Mukhil. He'll take you through it. Thanks.
All right. Thank you so much for that, Diksha. Yes. So, clearly we see that, there was a big shift, right? We went from primarily working with, largely LSPs, but then when you look at our capital allocation right now, I think it's almost split to the extent of, almost majoritarily our allocation is towards, digital NBFCs, right? And that's really how, how we've seen the market play out, right? Because ultimately the big benefit that we have when we are working with digital, lending NBFCs is that obviously they're much more compliant. The loan quality is, significantly better because they themselves, are very, very conscious of, taking any kind of, poor quality loans on their own book, right? And what does all of this meant, right? So let's talk about that for a bit. As we can see, right? Like I said earlier, right, this has really been a year of two halves. When we look at our AUM growth and when we look at our disbursement growth, right, I think our AUM, has pretty much skyrocketed, in quarter 3 and quarter 4, especially when I compare to, previous kind of quarters. And it's really, showing what the strategies basically, resulted in, right? One of the metrics that we kind of look at internally very closely is all, very obviously the disbursement growth, right? Because we are in a space where, the churn of loans is pretty high, right? Like people usually do very short-term loans in this space, which are maybe 3 to 6 months, mostly in kind of duration, right? So if we look at, just the disbursement of loans and compare quarter 1 and quarter 2, right, which was, almost like 17, 18 odd crores, and we look at, quarter 3 and quarter 4, which totally combined is almost close to 90 crores, right? Which is, quarter 3 and quarter 4 combined has almost been like a 4x jump in the amount of loans that we have disbursed, right? That itself shows what the strategy is basically yielding, and very honestly we expect this to only grow from strength to strength. Now I want to also highlight basically the quality of the loans, right? Because all of this strategy basically, right, when we basically taken a larger exposure in working with other NBFCs, either in a LSP or a co-lending model, right? One of the interesting things that we've kind of noticed, right, is that when we look at, the DPDs essentially, right, for, 90 plus, duration, right? When we look at all of the numbers from the past, right, one of the, quarters which stands out is actually quarter 4, 2024, right? And that's really when a lot of the discontinued partners' loans actually started disappearing from our book, right? And even though commercially, these DPDs had no impact on us because of our, commercial setups, pre-DLG, one of the advantages that we basically seen from working with, digital NBFCs is that essentially the quality of the book is, significantly better. In fact, we further deep dived into the 2.88% DPD that we see for, the 90 plus days. And in fact, 90% of the DPDs that we see in quarter 4, right, is coming from discontinued partners, which makes us, very, very confident that in fact, going forward, the numbers are even going to be much more significantly better, right? Much, much lower than even the 2.8% that we see. And that's just a positive, sign for us, right? Because ultimately, one of the things that we are very, very conscious of at Apollo is that, we don't chase growth for the sake of growth. We want that to kind of be reflected in obviously the bottom line and most importantly, the quality of the loan book, right? And what has all this meant, right? One of the clear things which we've kind of observed is that, now, as we kind of mentioned, even in our, last earnings call, right? We are really, really clear that our goal at this point in time is to absolutely put this pedal on the metal and scale up. In fact, we've rarely done this in the past, but, given the confidence and given the momentum that we are seeing inside, this is one of the first times that we are giving some kind of guidance, right? One is that, we're very, very confident that by, first half of 2025, we are going to be at 100 crore, capital commitment, from the various, partners that we work with. We've already made significant progress on that. In fact, as of today, we are almost close to 65 to 70 crores already, right? So we are making incredible progress towards this, and we're very confident to be at, 100 crore, quite comfortably by, H1 of 25. And most importantly, on the fundraise bit, right? I'm sure like some of you guys saw that, we had put out on the Bombay Stock Exchange that, we are going to be raising an NCD worth about, 15 odd crores. And very honestly, we've been blown away with the response that we've got, from the subscribers, right? I would say, from a commitment perspective, it's already committed, to be very honest, right? And we think in the next 30 days itself, the entire 15 crores will be allocated. Post that, we will be obviously exploring a new cohort of NCDs because, we see tremendous growth, right? And in order to summarize, I would just say that, looking back, I think, the digital lending guidelines have been a huge blessing, for Apollo, essentially, right? Because before that, yes, we were scaling and we did have really positive numbers. But, as, a lot of you guys have asked us in the past, right? Like, why aren't we, putting the pedal on the metal before, and why aren't we scaling to big numbers? The reason was always because, we always kind of suspected that at some point in time, digital lending will become, big enough that there will be, very, very strong supervision from RBI. Now that that's happened and the rules are absolutely clear, right? And, it's very, very important to scale once you know what are the different variables involved, especially in a regulated industry, right? And I've done this before at PharmEasy as well, right? Like, you can only scale once you know what the regulator really, really wants you to do very, very clearly, right? And now we feel that moment is here. And, as you'll observe, obviously in the last 2 quarters, and we expect this to continue over the next, couple of quarters as well, there will be, a significant amount of growth, that we are expecting, to happen at Apollo. We've already made moves, to support that kind of growth with the NCD, that we are basically, committed in terms of, 15 crore. Going forward as well, we will be actually raising more. In fact, starting next week, our team will be interacting with, with you guys, right? Our shareholders, basically, to tell you a bit more about this NCD raise, because in the past, we've gotten a lot of requests, to participate in the NCD as well. So we will be obviously opening that up, for our shareholders as well, and our team will be, reaching out, and in case anybody also, is interested, feel free to reach out to us. But, our team will also be proactively reaching out to you guys, obviously in order to support, future growth. With that, I'd like to pause. And, as we always like to do, we would like to, stop this and basically interact with our shareholders. So if you guys have any questions, we would love to kind of interact with you guys and take those questions at this point in time. Thanks.
Thanks, Michael. Thank you so much. That was really insightful. So we have a shareholder who intends to ask a question. Mr. Raghav, I'll just unmute you. You can go ahead and ask your question.
Hi, Michael. Thanks for the clarity. I have one question. So as you're indicating, we will be touching 100 crore AUM very soon, right? So what kind of revenue and profit margins we can expect? Let's say base case of 100 crore quarterly basis or annual basis, whatever you feel is easier to give. Am I on?
You want to unmute yourself?
Yes. Sorry about that. So I think, at this point in time, the right way I would always, kind of think about it is, it's too early to comment on the kind of profit and the revenue that we would, expect, right? Like, to me, I would feel like I don't think our margins are going to, let me talk about ROE, right? Because that's a metric which we kind of look at internally very closely. Obviously, as compared to the last year, I'm expecting this year for us to have significantly better ROEs, right? Largely because, when I compare it to last year versus this year, obviously this year we're expecting, our capital to be significantly well deployed, right? Last year was I would say Q3 and Q4 was all about, finding the right business model, and obviously scaling up as we've obviously seen. I think this year, we're expecting, that to continue. So obviously that will translate into significantly better ROEs. Even the kind of NCDs that we've, obviously raised so far, and got commitments for the 15 CR. I think, we think it's at very, very attractive rates. So I think that will all help boost ROEs, and obviously that should translate into, profits and, revenue as well. Though personally, like I don't look at, revenue very, very closely. I always kind of focus a lot more on ROE and profits. So that's at least my personal take on it.
Okay, thanks. I do have a follow-up question. Do you want me to raise it now or later?
No, go ahead, please.
So we are a digital NBFC, right? And we are also doing a partnership with another digital NBFC. So I understand that probably our tech stack is pretty cool and people want to do tie-ups with us. But how do we see this relationship going forward? It's like Apple merging with another Apple. Maybe we are slightly better in terms of tech, but isn't it that we are just bringing some more capital to the existing digital NBFC, and that's where they are doing tie-ups with us? How do we see this model evolving further?
That's a great question, Raghav. In fact, I'll take this to kind of zoom out a bit, right? Across the last, 7-8 years of us building Apollo, right? I think, one of the questions that we used to always get asked, just to give everybody a recap, right? Over the last 7 years is, the first question we used to always usually get asked is, usually, like I'm talking about the past right now, is that we used to largely work only with LSPs, right? And the question at that point in time used to usually be from our, investors that, what happens if everybody gets an NBFC license, right? Like then nobody will work with you. And our answer always used to be that, it's not about the NBFC license. There are 10,000 other NBFCs in the country. At this point in time, we don't think we are special because of the license. We think we're special largely because, our tech is phenomenal, right? And, honestly, the answer remains more or less same even to the current question, right? Like I think now we've clearly answered the question, at least the first part of the question, which was, what happens when, mostly, people have an NBFC license. Obviously today, not everybody's got an NBFC license, but we've chosen basis our evaluation to work more with, digital NBFCs largely because of their ability to scale and create good quality books. Now, why do they work with us, right? I think the reason why they work with us and, I interact and, our entire team constantly interacts directly with, the founders, CEOs and CXOs of those companies, right? The constant feedback that we get is that, working with Apollo means basically, the few advantages, right? The biggest advantage at this point in time is that they are able to, not only do very, very quick integrations with us, like literally they are able to go live within a couple of weeks, whereas with any other NBFC, it takes months, right? Because, hypothetically, say if you had to contact any other NBFC like a Northern Arc or a Vivriti, I think to get in touch with them, it would probably take 2 months, right? Then for them to evaluate you, it would take another 2 months. And then for them to integrate with you will probably take another 2 to 3 months, right? So realistically, that's incredibly painful, right? And let's look at, the process with Apollo, right? If you had to get in touch with Apollo, I think within 24 hours, somebody would, kind of get back to you. We complete our evaluation process within 7 working days, right? Because we have a very clear guideline in terms of the kind of data that we need to evaluate a company. And basis that we issue a term sheet, right, to the partner that we want to work with. If the term sheet has been agreed to, within 2 weeks flat, they essentially go live with us, right? And that's only possible when you have A+ tech with really, really good documentation. And secondly, you have a team who's actually enthusiastic on onboarding new people and doesn't look at it as a, side activity. A lot of the other NBFCs, which are in this space, right? For them, this entire business of partnership, right, is more of a side business, right? And what basically happens, right, when you are a business which has, say, 100 rupees worth of revenue, right? If you do a partnership model and that, just contributes to 2 rupees of your revenue, the biggest problem which ends up happening over there is that the entire org gives it really, really, doesn't give it the love and attention that it deserves. So ultimately it leads to significantly poorer and poorer experiences. And most importantly, what ends up happening is when we work with these other digital NBFCs, right, or even LSPs at this point in time, they don't want to work with, lenders with whom they feel they could be potentially competitors, right? That is a problem, right? Like when you work with other NBFCs or, other banks also potentially, right, who could potentially do lending directly to your own customer, that is a huge problem in the ecosystem because a lot of these NBFCs, right, they are spending a lot of money on customer acquisition, they're spending a lot of money to maintain relations with their customers. The last thing that they want is to work with a lender who basically uses them just purely for lead gen and then later just takes all their customers and runs away. And we have seen this happen consistently in the digital lending ecosystem across the last 7-8 years. In fact, that's a very big reason why today in India, you don't see neobanking taking off, right? Because usually what ends up happening in this relationship is that the fintech entity, spends all the money, acquires customers, the lender at the back end, gets the data of all the customers and then sneakily reaches out to these customers on their own and breaks the trust. And therefore, there is no long-term partnership with any of these guys, which ends up being formed, right? And we've seen very public examples of this, right? Paytm has done partnerships with lenders in the past, and then those partnerships have unraveled in a matter of 2 to 3 months, right? Largely because of this problem, right? But when you think about Apollo, the DNA of Apollo is that of a platform, right? We don't have direct branches. We don't have an app of our own. That makes all of these guys believe that Apollo is an ally, right? So coupled with the really great user experience, they also feel strategically that Apollo is a fantastic partner to have because it is an ally. Apollo is a friend to all the lenders out there, right? And that's a great positioning to have from a strategy standpoint. And this positioning that we've had, right, it's been for the last 7-8 years. So it's a strong belief now within the ecosystem that when you partner with Apollo, it is a truly long-term strategic partnership, and they are not somebody who's going to compete with us. They're rather going to help us get to, our end goal, right? So all of these factors come together, Number one, the ability of us to go fast. Number two, our incredible tech stack. Number three, our strategic positioning in the ecosystem. These three things combined. The last fourth one, which, I really believe matters in B2B, right, is that the chemistry between two teams. When we look at the DNA between, an Apollo and the other digital lenders out there, there is a big DNA match, right? Because the kind of people working in both these institutions are very, very similar in thought process and DNA, right? And in a B2B, partnership, chemistry between the two companies is incredibly important, right? And finally, deals are done between human beings, right? So ultimately, that also makes the entire, process of onboarding partners and getting partners so much more smoother rather than, when you have a 35-year-old talking to a 55-year-old, right? That chemistry sometimes just isn't there because sometimes the 55-year-old doesn't see value in investing in a partnership with a young company, right? So a lot of those things kind of combine and have worked together for Apollo over the last, 7-8 years now.
Understood. Thanks for a broader explanation. All the best. I will join the queue. I have one more question, but I think I should not be holding the call. Yeah.
No problem.
Thank you, Raghav. Thank you so much. We have Mr. Matthew. Mr. Matthew, I'll just unmute you. You can go ahead with your question.
Yeah, sure. Yeah, congrats on the good set of numbers. I have 2 questions. First is that, let's say, in the last quarter, the presentation, right, it was shown that the AUM has grown 3.7x, right, quarter on quarter. But let's say when I check on the revenue growth, it's around 50%, right? 50% is also, it's very good, but I just wanted to know why is that difference? That is the first question. Second is that now since we moved back to the growth phase, right, roughly around the same time, RBI also started taking more actions on, let's say, the unsecured personal loans, right? I mean, we have seen the let's say, multiple warnings and all those things, right? So will that hamper our growth back, or like, what is the take on that? Because we are primarily in that space. So these are my 2 questions.
Yeah, both are actually fantastic questions. I want to definitely, talk about them in detail, right? So I think the first one, which you had a question is, why isn't like, basically the growth in AUM kind of corresponding with the growth in revenue, right? So I think to answer that question, I think Diksha talked about it a bit, but I'll double click on that a bit, right? So I think when we are collaborating with digital NBFCs, right, the difference between an LSP collaboration and a digital, NBFC collaboration is that whenever in the past, right, we were working with LSPs, the model used to be in such a way that, obviously all of the, interest and processing fees, etc., from the customer used to come directly into Apollo, and Apollo used to pass that back into the LSP in the form of commission, right? So obviously over there, the revenue used to be shown or the accounting over there is done in such a way that the revenue bump is definitely there, right? But what happens now when we are collaborating heavily with NBFCs is that when we collaborate with NBFCs specifically in the co-lending model, right? What ends up happening is the share of commission given to them is significantly lower, right? The reason is because when we are co-lending with them and hypothetically say in 80-20 proportion, right? 80% of the money obviously flows into us, right? Which is the interest portion of it, right? But 20% of it, right, which is their input, right, flows directly to them, right? Because that's how the co-lending, laws essentially work, right? Where the interest income has to be split in the proportion of the participation in the loan itself, right? And any commission that we are paying, the digital lending NBFC, right, for them doing the collections on our behalf, for acquiring the customer on our behalf, is much lower than the commission that we used to pay in the past when it comes to LSPs. Therefore, in a co-lending model, right, the revenue which basically Apollo can earn is lower than the LSP model. But from a bottom line perspective, both of them are exactly the same, right? Because in both these models, the ROI that Apollo is basically earning is exactly the same, right? So it's purely to do with how accounting is essentially done in co-lending as to why the revenue is basically reducing, right? So that's the first part, of your question. To answer the second part of your question, right, that, RBI obviously has come out and, increased basically the risk weightage for unsecured loans, right? Over there, the beautiful thing about Apollo, right, is that, today our debt to equity is minimal, right? So this heavily impacts companies whose debt to equity is already significantly high, right? Because then for them to borrow funds, right, it becomes a problem, right? Because they can't borrow as much amount of money against unsecured, loans as, as they could before, basically, with the risk weightages being high. Today, the good news for Apollo is the headroom is so high, right? I mean, realistically, we could go, from a debt to equity perspective of easily, 2 to 3x very smoothly from this point in time onwards, right? And we've seen this, by the way, across a lot of digital NBFCs that we work with, that, they're already at debt to equities of, 2 to 3x, right? So the headroom for Apollo is very, very high. In fact, that has turned into a huge opportunity for us, because at this point in time, there has been a slight dearth of or a reduction of capital available to, our potential partners, right? And that's also been a strong reason why they've come, knocking at Apollo's door and want to even explore deeper collaborations with us, because we have a lot of headroom yet left, right, from a scale perspective. So from a timing perspective, I think it's added to Apollo's growth trajectory at this point in time.
Thanks, Nikhil. Just one bookkeeping question. How much is our this one, like, let's say, net worth and the loan book value as of now? Like,
I think I am not 120% sure of the numbers, but last I checked, right, our net worth was about 60 odd crores, and our AUM, right, or I typically track capital commitments, as of today was, I think, somewhere close to 65 to 70 odd crores.
thanks, Nikhil. Yeah, I don't have any other question.
Sure.
Thank you so much, Mr. Matthew. We have a few questions in the Q&A section. I would request Mr. Naren to unmute himself and ask his question.
Yeah, thank you. I just wanted to know when we will cross the kind of revenue that we made in FY2021-22.
I think very honestly, Naren, like I mentioned, our focus really isn't on revenue, right? Our focus is more towards, growing the business. And I think that will translate more into, I would say the ROE and the profits. So largely, like I mentioned, I think in the, to Matthew as well, I think, who asked this question before, right? Given the new business model that we operate in from a co-lending standpoint, what will essentially end up happening is that in co-lending, the flow of commission to our, partners is significantly lower, and therefore the amount of, top-down revenue which comes into Apollo is, lesser than the LSP model. Though in both models, like I said, right, like, from a PAT or PBT perspective, it makes no difference to us.
Yeah. Okay. I just wanted to know what is the reason for the reason for the revenue to come down actually? Is there anything
Yeah, the
strategic?
reason, yes, I think like basically I mentioned, to Matthew as well before, right? It's largely to do with, two big factors, right? The big factor, one of the big factors I would say is, the last year, like I said, was a year of two halves, right? I think quarter 1 and quarter 2 was more about evaluating, how do you kind of process and figure out the strategy after DLG, right? Quarter 3, quarter 4, we figured out our strategy and absolutely rampantly scaled up, right? And that's why when you see in terms of loans disbursed, right? Quarter 3 and quarter 4 combined, we did almost 4 to 5x, loans that we did in quarter 1 and quarter 2 combined, right? So that's a humongous ramp up. That's, point number 1. But obviously quarter 1 and quarter 2 had significantly, lower revenues as compared to quarter 3 and quarter 4, right? But obviously the right way to think about it is, really look at quarter 3 and quarter 4 and project that, for what we expect to happen, kind of going forward this year. So that's part 1. Part 2 obviously is to do with our new strategy of working with, digital NBFCs, right? And when we work with digital NBFCs, the big difference between working with an LSP who doesn't have a license versus working with an NBFC who has a license in a co-lending model is that when you work with an LSP, all of the ROI and the processing fees of the customer comes into your book, right? Because Apollo is the exclusive lender over there, right? Any commission, etc., which is to be paid to our LSP has to be paid by Apollo whole and sole. So what ends up happening over there, obviously the revenue here is much higher, right? But when you compare it to a co-lending model, the ROI has to be split in the proportion of the loan contribution, right? Which Apollo does usually 80 and maybe the partner does 20, right? So 80% of the interest comes to Apollo, 20% of the interest goes to the lender directly. Usually for an LSP, right, that 20% would have been given to them in the form of commission and would add to our revenue. But over here, since the 20% is going directly to the lender, right, it obviously doesn't add to your revenue. So most importantly, both these models make no difference to your PBT or PAT, essentially, right? But it's just a different way of accounting between co-lending and an LSP model.
Yeah. I just have a follow-up question. The reason is I wanted to know, NBFC is making tie-up with us. Once they scale up, what happens? Do they continue with us or what happens to the format? Even if they become a very big NBFC, what restricts them from making their own tech stack or their own, doing it on their own without having our tie-up? Is that, I just don't know how to frame it, but the question is, as they scale up, they become bigger. They become bigger than what they are. And suddenly they want to do their own things. What restricts them from leaving our tie-up and doing it on their own?
Nothing restricts them, right? Like, to be very honest at this point in time, also, just to give you some perspective, right? We don't work with small NBFCs. I would say a lot of the NBFCs that we work with are, having AUMs of upwards of 1,000 crores, right? That's testament to the fact that despite being, systematically important NBFCs, despite all of those things, they are choosing to work with Apollo, right? And the reason is exactly what I said in the past, right? It's a combination of A, how quick we are. Second, it's about a testament to how great our technology is. And, number 3, it is a question of chemistry, right? If both the teams, get along well with each other, it is, critical. And most importantly, I think they look at us as an ally rather than as a competitor, right? All of these factors combined is the reason why today, even systematically important NBFCs having AUMs of upwards of 1,000 crores, and some of the names we've even put in the presentation, right? They are, they are working with Apollo, and not only are they working with Apollo, they are giving us, capital commitments for a year and more, right? So, we have no fear of essentially, losing them in any way.
Yeah, thank you very much.
Yeah.
Thank you, Mr. Naren. We have one more investor who has some questions. Mr. Vijay, I'll just unmute you. You can go ahead and ask your question.
Hey, hi, Nikhil and
Hey.
Ikshata. Congratulations. At least you're able to figure out now how to work around with the new guidelines, and you're being talking a little bit more confident than how you used to be in the past calls. And
Yeah.
shared details also have been a little bit more than what it used to be. And hope I'm sure you will going forward improve upon this. My simple
Definitely.
question is, you were saying that second half you have seen a multifold growth in the AUM. But if I really look at your P&L, the PBT in the second half is lower than the PBT in the first half. I'm little concerned that you've been saying what we have seen in the second half is what we can extrapolate about what is going to happen in this year. So if you can clarify on this. Because if I really see your PBT in the first half was 6.5 crores, and in the second half your PBT was 3.75 crores, which is lower than.
Yeah, and that actually has primarily to do with actually the impairments, right? And I think Diksha, do you want to talk about this a bit?
Sure.
Yeah.
Hey Vijay, hi. So I think the impairment part we did cover in our presentation, but I'll just take you through it. So basically what has happened is...
Yes, you were showing it as a 5.5 crores, but you mean to say most of it came in the second half, or entirely it is in the second half?
I think our write-off policy was such that all our pre-DLG and all our previous year delinquent loans, they all reflected in the March quarter when we decided to write them off. So just so you know, this is the first time we've truly written off loans. And the impact of that is what we are seeing in our Q4. That's not ideally how we would have liked to present Q4 to our investors. But one learning for us from an accounting standpoint is that in the coming year, we make sure our ECL provisioning and our write-off policies are more descriptive of our true PAT. So that they sort of describe the true PAT to our investors in a better fashion. This is sort of not giving you an idea of a true PAT, considering our write-off policy has not been very aligned, honestly.
So the entire 5.5 crore of impairment has been taken in the fourth quarter?
Yes, that's right.
Thanks. That clarifies.
Yes. All right. Anything
All
else from you? All right. Thank you. Thanks.
Thank you so much, Mr. Vijay. We have Mr. Darshan Patel who has a question. Mr. Darshan, you can go ahead and ask your question.
Am I audible?
Yeah, you are.
Okay. So Nikhil, I have two questions. The capital commitment that you have mentioned, is it the additional capital or the total capital?
Total capital, right? So we expect that by first half of 2025, we should be at 100 crores of capital commitment. So that would be a total.
Okay. And one more question. The capital that we are planning to do, is it through the same NBFCs that we have been using or through new NBFCs that we are planning to onboard? And if it's the same existing NBFC, is it because our technology is superior?
I think, no, it's a combination. I mean, we are definitely onboarding even more partners, as we speak, right? So we expect the number of partners to definitely do go up. So it will be allocated across, our existing and, future partners. I think on the technology front, very honestly, I think, I don't, I feel, from an experience perspective, right? I don't think it's a far stretch to say that, from a fintech perspective, Apollo's technology, I think, is the best in the country, right? And it's a combination of, I think, us having been doing this for the last 7 years and also a testament to our technology team, and the way we build products, right? We do it with incredible amount of focus, and we do it with incredible amount of efficiencies. And this is, all also translates into the fact that, we are able to achieve the kind of numbers that we are able to achieve with, just 30 people in the company, right? There's no way you can do any of this stuff unless, you have a great technology, right? And even going forward, right, this is something you will continue seeing, like despite the ramp up in terms of AUM, which will kind of continue this year also, you will see like the number of employees will not change, more than 10-15%, right? Which is maybe we'll go from 30 to 35 people, but I don't see like a significant step change, right? In terms of employees, right? And all of that kind of goes back to how well, our product and technology team tends to basically plan and build really, really solid and highly scalable products.
So the capital commitment will be facilitated completely through our platform, right?
100%, right? 100%. Like we, this has always been what Apollo does, right? Whenever we talk about capital commitment, this is all on our book, right? This is all our capital getting 100% committed towards them. This is not any other number.
Okay, understood. Thank you so much.
Thanks.
Thank you so much, Mr. Darshan. We have Mr. Atul Rastogi. I think he has a question. Mr. Atul, you can unmute yourself and ask the question.
Can you hear me?
Yeah.
Yes.
Yeah. So, I just had one or two questions on one. You earlier used to get some per transaction fees on your tech with your LSVs. Do you continue to get that, or it's only the co-lending fees now?
No, we do. We do continue making, margins on the APIs that we basically have.
Okay. And secondly, co-lending is generally 80-20, right? 80% to one partner and 20% to the other partner. So you will be the 20% partner or the 80% partner?
We would be the 80% partner. In most cases, we would be bringing the majority capital, and the other partner would be doing the sourcing and the collections of the loans.
Okay. So the credit evaluation model is yours, and it's similar across all the partners, or it can differ? How does that work?
The credit model definitely is ours. That's point number one. And in fact, I think in the last couple of days, we also wrote a blog on this, right? As to how our credit engine is becoming smarter and smarter, because I think now we've done, I think almost 20 lakh plus loans, and, I think, lakhs of customers at this point in time, specifically in digital lending, right? So we have really, really ramped up in terms of, how high quality it is, right? Largely because we have a massive database of knowing what are the kind of customers which, actually repay back, and what are the kind of customers which don't pay back. We also have geographical specific data. What are the kind of pin codes where we've associated with, high risk versus low risk, because we've done lending across India. So we have a lot of data, right? Essentially. And, today our credit rule engine is just becoming stronger and stronger. And, finally, very honestly, in this year, we started to flex our data muscles, right? Because we wanted to reach statistical significance. And, with the new model, obviously of working with other, lenders and NBFCs, we've obviously started to deploy that, very, very heavily. And that's always, that's obviously paying dividend, right? Because when you look at our DPD numbers, which I've, showed in the slide, it's, pretty much at its all-time low. And very honestly, I'm expecting the next quarters to have even much, much lower numbers, right? Because like I mentioned earlier as well, even the 2.8%, 90% almost of that, right, is coming from discontinued partners. So going forward, we expect our numbers to be even lower. So yeah, like from a credit rule engine perspective, the performance is in the numbers, right? And, you will kind of see that in the quarters going forward. What was the second part of your question?
No, that's it. If I can just squeeze in one more.
Sure.
Do you have a specific profile of your borrowers or size that you're looking at, or it just basically depends on the partner and you go along with him?
Not really. I think we have a sweet spot, right? So we like to do, loans which are, probably less than, a couple of lakhs in terms of ticket size. And we also like to keep the duration, to be usually in the 3 to 12 month kind of spot, right? So that's a sweet spot. That's what we know really well to do. And also, very honestly, we believe that that's the sweet spot in general for digital lending, right? I think anything above and beyond those kind of numbers, it's questionable whether, uh, doing digital lending is really the best way forward, right? At least, for us, that's our, take at this point in time. We always keep it, ideally within these kind of realms.
Okay. Thank you. Thank you so much.
Yeah. Thanks.
Thank you, Mr. Atul. Mr. Mukesh Kothari, you can unmute yourself and go ahead with your question.
Hello. Am I audible?
Hey, hi.
Yeah,
Yeah.
hi, Nikhil. I know you have been trying to change wheels in a moving car, and you have been pretty. Q4 was pretty decent except for the write-offs, which I think is an aberration and won't get repeated again. I had few questions. When you say capital commitment, what exactly do you mean by capital commitment? Because if I look at your balance sheet, 60 crores is the current net worth that you have and 6 odd crores that you have borrowed. Plus, you would be getting another 15 crores in terms of loan, NCD that you were talking about. So, which makes to about 80 crores. So, I just want to understand what is your definition of capital commitment?
Yeah, that's a great question. What I mean by capital commitment is that every time we partner with, an LSP or an NBFC, right? We basically, whenever we allocate any degree of capital, right, we ensure that a partner comes on board and he takes, when he says and when we agree that, you're going to be basically using, say 1 crore worth of capital or 2 crores worth of capital in order to do lending, right, to the end customers, we take a commitment for a minimum of a year, right? And that really benefits us in few ways, right? Because number one, this means that our capital is obviously deployed for a period of 12 months at the very minimum, which means that you're going to be earning interest on that, regardless of the churn which your partner will do, right? But most importantly, obviously, when we're working with partners, they are very smart, right? They're obviously not going to take on commitments which they can't honor. So what this basically means is that we attract partners who are highly committed, who are extremely confident of not only absorbing the capital that we are, they're committing to us, but honestly, they're looking for much more and to scale, right? So this tends to attract mature companies, and this tends to attract companies who are very confident of managing their ALM, essentially, right? And this has been a strategy for us since the start of Apollo, right? So when I talk about 100 crore capital commitment, I mean lines of 100 crore given out by Apollo, for which Apollo will be earning, interest on that 100 crore across 12 months, basically, right?
Understood. So,
yeah.
Sorry to interrupt. So, if you look at the current loan book, which is about 60 odd crores, this could grow to 100 crores is what you're saying.
Absolutely, right?
Oh,
like
okay.
As of today, right? We have a scoreboard inside the company. So, the capital commitment that we have is almost 65 crores, right? We expect that by, hopefully by first half of this year, right? H1, we expect that number to be 100 crores, right? So 100 crores of capital commitment. And that means we'll be learning interest on 100 crores, for a period of 12 months.
So these would be irrespective of whether they are drawn or not, undrawn.
Yes. Yes. So, when I say 100 crores of capital commitment, I mean 100 crores of capital drawn.
Okay. So you're saying your loan book by H1 will be close to 100 crores is what I understand.
So there's a difference between loan book and capital commitment, right? It means that we will be earning interest on 100 CR. The loan book, can be slightly lower because, the money can be keeping on churning. But the way Apollo basically earns, right, is that we earn on the lines which are committed. So it is hypothetically possible, right, that somebody takes a capital commitment from us, worth 10 CR and maybe their AUM is 8 CR, right? Because they're inefficient and they're not able to deploy the 2 CR, right? But for Apollo, it doesn't matter because we earn interest on 10 CR.
Okay.
Right.
Understood.
So that's what I mean by capital commitment. That will be money that Apollo will be earning interest on.
Right. Understood. So there must be a commitment fees if somebody is not drawing. Okay. Understood.
Exactly.
Okay. See, you have in your presentation for the first time declared the 5 NBFCs that you're partnered with. One of the names is missing. Is it possible to disclose the name of the fifth one? There are 2 companies that have been disclosed.
Sure. So I think honestly, now, thanks to the new RBI guidelines, right? Like I think there is a dedicated page on our website which talks about all of our partners, right? Because RBI requires you to disclose, that, right? So I think, yeah, it's not a problem. I think, just to give you guys some more clarity, right? I know we've given a lot of information in this call, but for the benefit of all our shareholders, by the way, we are going to be doing a blog, right? Which should go out sometime today or tomorrow, which will have all of this information inside a blog. I think your request, will get fulfilled inside that blog.
Great. Okay. The second question I had was, see, if I look at branch website, I mean, this is one of your partners. They typically give out loan at 13%, 11 to 13%, depending on the tenure of the loan, 3 to 12 months. So which is what would be the yield that you will be earning, right? If I understand that correctly. So that is the yield that you are getting, basically 11 to 13%. Or
11 to 13. No, I think that number seems too small. I'm not sure if you're on the right branch website, but typically, at least to my knowledge, right?
Right?
Sorry?
It's a P2P NBFC, right?
No, it's not a P2P NBFC.
Okay.
Branch it's a San Francisco based company, right? I think it's, funded by, really A+ investors like Anderson Horowitz. So I think if you just type branch Anderson Horowitz, you should be able to kind of go on their website. But typically they lend between, I think, upwards of 24% or so in terms of ROI per year that they charge their end customers.
Okay. What would be your typical cost of funds then?
So the capital commitment, ROI that we basically typically charge could be anywhere between 16.5% to 18%, right? That's typically the range of ROI that Polo charges.
Okay. And what is your cost of fund? I mean, I just want to understand the spread that you retain.
So today, very honestly, our debt is insignificant, right? Like we are not even at 0.5 debt to equity. So, that's not that's not the right metric to kind of look at. I think, going forward, we are hoping to raise, debt. And I think once we have more information, on that, we'll obviously share. But I think today, as of now, in terms of NCDs, at least when we've raised, right, it's all been, below, 12, 13%, right? But I think once we raise, I would say a significant amount, right, we'll get a better understanding of what's the kind of, ROI that, we are looking at over here. But as of today, it's in the, 12% and below mark.
Okay, understood. I mean, just final 2 metrics that I want to understand.
Sure.
What is your current NPA ratio and what is your current capital adequacy?
I think in terms of NPAs, right, I think as we kind of disclosed in the presentation, right, Q4 90+ day DPD numbers were about 2.8%. But as we kind of spoke about before, right, over there also 90% of those DPDs are actually coming from discontinued partners. So, we expect going forward, right, in the coming quarters, the DPD numbers should be significantly lower than even that, right? I think I don't have the capital adequacy numbers at the top of my head. Maybe you could, send us an email and our team can kind of get back on that.
Sure. Fine. Thanks. All the best.
Yeah, thanks.
Thank you so much, Mr. Mukesh. We have Mr. Nitin Sethi. Mr. Nitin, you can unmute yourself and go ahead with your question.
Good afternoon, Nikhil. My question is, as our credit engine requires a lot of data, or for a better credit underwriting, we need more data. Can we give Sonic to other NBFCs for this as a software as a service so that we can get more data about more borrowers?
Yeah, that's a great question. Honestly, we did think about this in the past as well, right? I think there are a few problems to that. I think, very honestly, if you ask me, I think it's very difficult in India to be a SaaS company, right? Because I don't think anybody wants to pay for software. I think the reason why, the only caveat I would say to that is the reason why Apollo makes money today, using our tech and APIs is largely because it's coming with capital, right? So that's a very good combination, right? Because people people will take that combination, right? But if you go out in India to try and, just purely sell, a software, I don't think that's a very high ROI adventure, right? And I've not seen, any evidence contrary to that, at least in the, ecosystem that I've been evaluating, right? So we definitely don't, want to go into that because we don't think that, our energy is, well spent in that direction. Number 2 point, even if, magically we're able to get, NBFCs obviously to start using your LMS, I think the biggest challenge will be that they will not be okay, obviously, on you using the data, right? Because obviously they want that data to be completely, there, and they would want it to be hosted on, their data servers. So I think that's another big blocker. And I think finally, number 3, I think the biggest reason why we've also not pursued something like this is, we really believe technology is our secret sauce, right? And we are in, we are not at all interested in actually giving it out to any other NBFC because honestly, it would make them as efficient as us. And, why would you give away your secret sauce, right? Essentially. So we don't have any motivation to do that at all, right? It doesn't kind of fit, our overall strategy. And we strongly do believe that, our technology is what sets us apart from all the other, probably 1,000, 2,000 NBFCs which are active in this country, right? And that always kind of, shows through our ROEs, right? Even when I compare our ROEs right now to other digital lending NBFCs and we evaluate, like we evaluated pretty much most of them at this point in time, we are in, it's not an exaggeration to say that, our ROEs are the best, right? Or the best in class for sure. So I think all of that kind of goes down to how efficient Apollo really is, right? In terms of, the amount of money that we spend to generate the kind of, revenue and profits that we do, right? So I think all of that kind of comes from our tech and, it doesn't make sense to give away your secret sauce. So, that's not something we would actively pursue.
Okay, thank you, sir. Sir, another question. Do you think that AWS will be a problem in case of that sometime if RBI comes and say that AWS is a data server is of outside company, it is not based in India, then it will be a problem that we are using AWS?
No, so actually to answer your question, right, like actually this is a problem which has already been solved. I think, as of today, right, AWS itself has opened up a lot of their servers actually located in India. If I'm not wrong, RBI actually already came out with this in their original digital lending guidelines that you cannot store data outside India. So everybody pretty much in the fintech space already, I mean, whatever server they're using, right, they're using the India version of that, right? So even our data, by the way, is stored inside India in AWS servers, which they've hosted inside India, right, specifically. So that is something which has, already happened and, fortunately the entire industry has already kind of, dealt with that very efficiently.
Do not we keep any copy of data on another cloud service provider in case of emergency, or we have some just type of backup with something?
We do have backups, right? We do have backups, that we keep, obviously, right? Like, that's something which is incredibly important. Right. So we do have backups. We obviously don't want to disclose a lot of information about how we do our backups, but yeah, rest assured that, we have all the important data inside the company is, backed up, on multiple different servers. So there is no single point of failure, which we have to be worried about.
Okay. Thank you, sir.
Welcome.
Thank you so much. I think we are done with all the questions. Yeah. This was very insightful. Seeing that there are no further questions. Yeah. So I think this is the end of this investor call. It had been very insightful, Nikhil. Thank you, Nikhil. Thank you, Diksha. And thank you all the investors and prospective investors for joining us. If there are any further questions, in case you have, please drop your questions on our email ID, which is compliance@apollofinvest.com. And we'll be happy to answer all your queries. Thanks a lot. We'll see you in the next investor call. Thanks, Nikhil. Thanks, Diksha.
Thanks. Bye.
Bye-bye.
Thank you, everyone. Bye-bye.